Accounting terms are important for students, job interview, or making an investment in stock market. Accounting terms are the backbone of an accounting student. The important accounting terms I write with red and other in blue. Let me explain accounting terms to you one by one now. Accounting equation. Assets are equal to the sum of liabilities plus owner equity. This equation is reflected in the format of the balance sheet. Accounting system. The personnel, procedures, records, forms, and devices used by an organization in developing and communicating accounting information. American Institute of Certified Public Accountants. The National Professional Association of Certified Public Accountants. Carries on extensive research and is influential in improving accounting standards. Also developing auditing standards and administers the Uniform Certified Public Accountants Examination. Annual Report. A document issued annually by publicly owned corporation to their stockholders, including audited financial statements for several years, as well as non-financial information about the company and its corporations. Assets. Economic resources owned by an entity. Auditing. Performing an investigation enable the auditor to express an independent opinion as to the fairness and completeness of a set of financial statements. Balance sheet. The financial statement showing the financial position of an entity by summarizing its assets, liabilities, and owner's equity at one specific date. Business entity. An economic unit that controls resources, incurs obligations, and engages in business activities. Capital stock. Transferable units of ownership in a corporation. Certified public accountant. An independent professional accountant licensed by a state to offer auditing and other accounting services to clients. Corporation. A business organized as a separate legal entity and chartered by a state, with ownership divided into transferable shares of capital stocks. Cost principle. The widely used principle of accounting for assets at their original cost to the current owner. Creditor. A lender, an entity to which money is owed. Disclosure. The accounting principle of providing with financial statements any financial facts necessary for the proper interpretation of those statements. Fair. A term used by accountant to describe a set of financial statements that are complete, not misleading, and prepared in conformity with generally accepted accounting principles. Auditors express their opinions as to the fairness of financial statements. Financial accounting. The development and use of accounting information describing the financial position of an entity and the results of its operations. Financial Accounting Standards Board. An independent group that conducts research into accounting problems and issues authoritative pronouncement as to generally acceptable accounting principles. Financial position. The financial statement showing the financial position of an entity by summarizing its assets, liabilities, and owner's equity at one specific date. It is also known as balance sheet. Financial reporting. The process of periodically providing general-purpose financial information as a financial statements to person outside the business organization. Financial statements. 4 related accounting reports that concisely summarize the current financial position of an entity and the results of its operations for the preceding year or other time period. Generally accepted accounting principles. The accounting concepts, measurement techniques, and standards of presentation used in financial statements. Examples include the cost principle and objectivity. Going concern assumption. An assumption by accountants that a business will operate indefinitely unless specific evidence to the contrary exists, such as impending bankruptcy. Internal control. All measures used within an organization to assure management that the organization is operating in accordance with management's policies and plans. Liability. Debts or obligation of an entity that have arisen from past transactions. The claims of creditors against the assets of a business. Objectivity principle. Accountants' tendency to base accounting measurements upon dollar amounts that are factual and subject to independent verification. Owner's equity. The excess assets over liabilities. The amount of an owner's net investment in a business plus profit from successful operations which have been retained in the business. Partnership. An unincorporated business owned by two or more persons voluntarily associated as partners. Public information. Information which by law is available to the general public. The annual financial statements of large publicly owned businesses are public information. Publicly held corporations. Corporations in which members of the general public may buy or sell shares of capital stock. Retained earnings. The portion of the owner's equity in a corporation that has accumulated as a result of profitable business operations. Securities and Exchange Commission. The federal agency with the legal power to establish financial reporting requirements for large, publicly owned corporations. Also enforces federal securities laws, bringing legal action against possible offenders. Sole proprietorship. An unincorporated business owned by an individual. Solvency. Having the financial ability to pay debts as they become due. Stable dollar assumption. An assumption by accountant that the dollar is stable unit of measure, like the mile or gallon. A simplification assumption that permits adding or subtracting dollar amounts originating in different time periods. Unfortunately, the assumption technically is incorrect and may seriously distort accounting information during periods of severe inflation. Stockholders. Owners of capital stock in a corporation, hence, the owners of the corporation. Stockholders' equity. The owner's equity in an entity organized as a corporation. Transaction. An event that causes an immediate change in the financial position of an entity and that can be measured objectively in monetary terms. In current practice, transactions serve as the basic for recording financial activity. Window dressing. Legitimate measure taken by management to make a business look as strong as possible at the balance sheet date. I appreciate if you will like and share this video. It will take you just 2 seconds only. But it will enhance other person full life marks and concepts.